Hey, this is Sasha, and welcome to another episode here on Hungry for Returns. Today, what we're going to do is answer your trading and investing questions, and we're going to focus it around our calendar options related course because we have a course that just came out that's focused specifically on trading calendar spreads. Now, if you have a trading and investing question that you want answered, whether it's you want to send it in by voice or you want to write one in, visit our website at tradersfly.com. Now, with that being said, let's take a look at what we have going on in terms of our course real quickly. So if you're kind of new to our channel, we have a product that just came out that's related to option trading. Now, we have a couple of different option trading courses out there. We have our Option Mastery series that we're working on. One is the Foundations. We have Business of Options and Verticals, the Iron Condors course, which is kind of the recommended way of taking these courses. But if you want to skip around, you can. And just now we've released the Calendars course. Now this course is on promotion and on special. So you have a limited amount of days to get the course and get still a discount. Now this course is huge, 41 videos, 22 plus hours of training and 120-page study guide. So there's a lot of topics that we cover, from basics to volatility, neutral calendars, buying versus selling calendars. So there's a lot of different things in this course, packed, a lot of information. So if you're interested in looking and reading more about this course, take a look at the rise2learn.com/course overview options mastery series there. And just go to the Rise to Learn site. When you get there, go to the courses. You can either click the courses page, filter by the options, trading, and you'll find the calendar course there. Or you can just go to the option trading courses page there and you'll find it pretty quickly. Now, when we do these course launches, we do them at a discount. So if you're interested in picking it up, be sure to not wait too long because the promotions don't really come back in a long time. Simply because it takes a lot of time, energy, and effort to set up promotions. Instead, we'd rather be focusing on creating the content and material. Now, with this video, I'd like to share with you how trading calendar options can help your long portfolio, especially in bearish market conditions. And that's really one of the great advantages to calendar spreads. Now, diagonals also do very well, and even more so better for a longer portfolio, but calendars is the starting point. So when we do a calendar, we're looking to kind of make money every single month because we define a range. So let's say I'm looking for a calendar in Netflix, and let's say I go 30, 60 days out. So the way the spread works is you're naturally a seller of options, right? So you sell one, we sell a single here, I analyze the trade, but the problem here is I have unlimited risk if this continues to go to the upside, right? So here's our price of the stock, here's our profit and loss, and here's kind of the zero line. So I would make that much profit, but the problem is, of course, is the amount of risk. So when I look at it, if the stock stays under that 350 range or 355 range, I make about $2,240. So that's fantastic. But again, the problem is the upside. Now I could move this to 365, gives me a little more cushion, but there's too much movement. So you can see the decay here of the curve, options decay, and the decay is that curve. So you're making $34 per day on that decay, and that continues to grow with time as days continue to move forward, right? The rate of acceleration. Just like if you're selling a baseball ticket 3 months out, you can probably resell it at full price. If you're selling it 5 days or a day before the game, well, you probably won't get full price for it. So here, when we look at it, the next thing you want to do is you want to go ahead and look at buying some protection. So we'll do that at about 59 days out. So I'll go back to maybe the 355 and buy this time a single. And now you're going to see what this looks like. So we'll go 355 on both of them. And what happens is the decay on the closer month, you know, what you're doing is you're going like this on the decay, and then the month where you're buying the protection is going to be right here. So it's decaying this much. Whereas the later out in time, the one that we're selling right now in the front month, it's decaying right here. Whereas this is 0 days, and this might be 60 days. So that's kind of our decay curve when it comes to options. So the one we're buying for protection, we're kind of decaying, but very lightly. So the front month decays much faster, and because of that, it drops our theta, which is the money we make every single day, to 12, right? If we didn't have that protection, we'd be making $35 a day, but that protection costs us about 23 a day. So the difference between 35 and 23 is we make about $12 a day. So this is how we're set up to make money every single month. Now, we're looking at this as a range in this level. The problem is hey, we have risk in both directions. So typically in a long portfolio, this would be a little more bullish. So let's say you go 370 and maybe 370 here. So now you have a little bit more curvature there. Even if you go, let's say, to maybe 380 and 380 on this one, now you can see, hey, well, I'm looking for stock prices to go up, right? If you're looking for stock prices to go up, you would buy the stock and hold it. And this is what you're doing here. You buy the calendar and you're doing it kind of more of a bullish calendar. But the downside, of course, is if it moves too quickly, you could have the other problem. So this is why a lot of times many people also do kind of diagonals. And to do kind of diagonals, what they might do is kind of skew things a little bit like this. So you'll do a 390 where you're selling, but you're buying the 380. And now you don't have that much risk on the upside, because even if it overshoots it, you're still profitable. So I'll go ahead and do it at the same strike price though, because we're talking about calendars here, because you could still do the same concept. What it does is it cushions your downside a little bit. It's not as fast. Whereas if I go here to, let's say, the 385 or the 390, this really drops this lower. So it creates a faster delta here on the downside. Whereas a 380 is only a 4 delta, which means I'm making $4 as it goes up for every $1 move, but I only lose $4 if it goes down. The other one would be 10 because it's steeper, right? It's much faster. So here, when I look at these price slices right here, this is our price slice, 4 delta, making $9 every day. Now, as this continues to move forward, you're making a few dollars every day, right? And that's your curve. Now, even if it overshoots, as long as it takes, a week or two, a couple days, you're still fine because you can get out of it early. Now, let's say it pulls back. Here's the thing with calendars, and what's great about calendars or anything with positive vega is you're looking at this positive vega. It cushions you on the downside. So normally as prices go up, volatility comes down, which is what options are priced in. Is it part of it? And volatility will go down, let's say 2 points. So that shrinks your tent a little bit. Now that's not a good thing, right? You say, hey, that's not good. But remember, because you're bullish and positive, you'll have this theta and those days continue to work for you. So as it continues to move up, those days continue to decay and they continue to contract. So you make more and more money. Now, with volatility compressing, you say, hey, well, volatility keeps going down, so it hurts you a little bit, but you're making more and more money on that theta. And here's where this helps you big time in bearish markets or when things sell off. Let's say this was in your retirement account. Well, if things pull back, well, the volatility actually now starts helping you, because what if volatility starts going up? Well, let's say now we go back to our normal volatility levels, the tent starts expanding. Let's say, hey, now it keeps getting higher because prices keep going down. Well, now you're up, let's say 2 percentage points on volatility. Well, you keep going down, but you're not losing that much money because volatility is helping because you have that positive vega. Let's say it goes up 4 points. Okay, again, it keeps expanding. So you can see that it cushions you on the downside. It cushions you as you keep moving lower, because volatility will continue to rise as prices go down. Because what happens when stock prices sell off? They sell off fast, which means volatility increases, which means people that want these options, they're willing to pay more for them. And that's where you're making a little bit more cushion if you're holding this in a long portfolio kind of retirement account and that kind of thing. So when you look at it like this, let's say you're setting things up, at the 380, so it's pretty bullish, which means you have a lot of room on the upside. not as much on the downside, but your long portfolio, let's say it just starts to go down pretty quickly right here, and you get to your kind of break even, well, you got to remember it may take 1 or 2 days to do that. So you get a little on the theta, but let's say volatility pops, let's say 3 or 4 points. Well, you're actually still breaking even. Look at that. You're only up $1.66. You're not down $60 because that 4-point volatility move, because your positive vega helped you. Now, if you're trading iron condors or anything with negative vega, it would have hurt you as things went down. But in this case with calendars, that's why it cushions you on that move if prices sell off, because the volatility will offset that and help you out, especially if you have this in a long portfolio account, IRA type account, anything where you're looking for prices to increase. It's going to cushion you a little bit. Now, it's not going to cushion you, completely, because, as prices continue to sell off, volatility will still continue to increase normally. Let's say you go up 9 points, but you're losing more on the delta on the price risk problem. So volatility will cushion you, but not completely, right? So basically what I'm saying is you got a little bit of a safety net when you're doing these calendars, especially if you're worried about the downside. And that's why these are great to do as markets continue to head higher and higher and higher, because, hey, what if you get a downward move? Well, if you do, more of these calendars will cushion you on that downside, and you won't lose as much because you're holding those positive vega trades. And anytime they're just sitting and hanging out there, well, it's going to help you out because you have that theta that continues to work for you. Anyways, I hope this was helpful and insightful to how these calendar trades can cushion your position. If you're holding more long stock, long portfolio, if you're looking to do these for longer term durations, it really cushions you if things sell off, whereas just holding a stock is just going to pull it back. Now, if you're interested to learn more, head on over to risetolearn.com and check out our calendar course. We're going to have a sales video up on it shortly, which will really be an introduction video of all the different clips within the course. So we'll give a little bit of sample and taste of what goes on in the course, and check out the calendar course because we have it on discount promotion series. And if you're already a current member and you've purchased one of the older options courses like the Iron Condors one, the number 3, or the number 2 verticals one, there's an even bigger discount. So just log into your account and you'll see that discount reflected, because we always want to reward people who continue to stick with us. So check that out. You can also just hit the link in the description below and be taken to this page there on our website or our Traders Fly site, which will link you up. If you go to our Traders Fly site, if you hit courses over here, we'll be listing that course on here very soon as well. So going to any one of these will link you to our Rise to Learn site, and then you can navigate from there. So thank you so much for joining me. Hope you got a lot out of this video to understanding more of how these calendars can really cushion you for the downside. And if you have specific questions, then visit our website at tradersfly.com and be sure to submit your questions where you might be featured on the show, especially if you submit a voice-related question. Thanks again, and I'll see you next time.